Let's now welcome in Roger Aliaga-Diaz, Vanguard Global Head of Portfolio Construction. Roger, it is good to see you. So we have a rally here on Wall Street, Roger. I'm looking here, just green across the screen, all three major averages. S&P 500 breaking above 5,200 for the first time, Roger. But let's get your reaction. What did you make of what the Fed did and said today?
Yeah, no, I think the market reaction is understandable. At the surface, the SCP that you guys were just describing it seems very dovish, right? So they revise up the growth projections, they revise up the inflation projections. They were at 2.4 before, they're at 2.6 now, yet they still think they will cut 3 times this year, right? So that is a very dovish signal to the market. And I say the surface because below the surface, like how the different dots move shows a little bit more less easy.
Roger, it's Julie here. Dare I say Goldilocks? Is it time to bring back that word?
Well, certainly Goldilocks was last year, and the question is if those same supply side forces that Powell referred to in the conference will continue, right? Because with higher growth, this time comes higher inflation, right? So whether we're gonna have that tailwind that really allowed the Fed last year to have high growth with lowering or decreasing inflation is still yet to come. In our view, the inflation will remain stubborn. We think that the Fed has more revisions to do in terms of the rate cuts. We feel that it's going to be very difficult for them to get to that first cut unless the inflation picture really starts moving downwards.
To that point, Roger, I want to ask you this question. When you see the stock market reaction like this, this is a boost to financial conditions, Roger, right? I mean, doesn't this complicate Jay Powell's work ahead?
Yeah, absolutely. I think financial conditions, wealth effects are things that should be factored in, and that's it's a form of policy mistake in some sense, in a slight way, right? Because by moving up the growth and inflation projections, yet saying that they are going to cut the same, they are sending an easy signal to the market, which in turn, as you suggest, makes the job more difficult to bring inflation down, which is ultimately what they want.
So put it all together for us. Risk on for as far as the eye can see, Roger. What are the sort of risks to this continued rally, and sort of exemplified by the reaction that we're seeing today?
Yeah, no. To me, the risk is basically, and we have seen it since December. Honestly, that the markets are buying this idea of a soft landing, declaring victory too soon, in our view. I think basically we'll have to get back to reality at some point. If inflation continues being stubbornly high or not lowering enough, eventually the Fed will have to postpone and put off the date of the first cut more and more. And that's where we can see a little bit more volatility in the market. So that's a risk that I think as investors we need to keep in mind.
And Roger, I'm interested in another issue here. We do have a very divisive election coming up here. I'm just wondering to what extent, if at all, you think that's also impacting the Fed's decisions.
Yeah, I mean, the problem I think would be with the timing of the first cut, if it falls right there in the September timeframe, it could complicate things, right? Not that the Fed is not going to do what they need to do based on monetary policy, but ultimately the pressure and the criticism they will receive, whether they do it or they don't do it, will put them in the public scrutiny, right? So that's something that may limit a little bit what they can do.
Roger, thank you so much for your time. Appreciate it.